So before you dismiss reverse mortgages and before you decide that reverse mortgages are a terrible idea, or it could be a financial lifeline for you, you need to really understand something. They're not good and they're not bad. They're a tool to be totally used in a strategic way. And I've seen this tool create incredible flexibility for retirees. And I've also seen it quietly create disappointment and even family conflict when it's really misunderstood. But here's what almost no one talks about. There is one strategic way a reverse mortgage can be used, not to stay in your home forever, but to actually help you sell your home for more money without touching your retirement income. And I'll touch on that in just a moment. That conversation is almost never happening. So in this video, I'm going to break down what reverse mortgage really is here in Ontario and how much you can actually access. You see a lot of commercials these days about reverse mortgages. Here's more detail. Yes, you can have up to 55% of your home's value. Where it can go wrong is what the real cost looks like over time. In one scenario where it can be incredibly great solution. If you're retired or preparing to retire, this is something you should understand before you even dismiss it. So let's start with the basics. What is a reverse mortgage here in Ontario? Well, here in Ontario and also across Canada, a reverse mortgage is available to homeowners age 55 and older. It allows you to access a portion of the equity in your home without having to make monthly mortgage payments like a traditional mortgage. So instead of you paying the lender every month, as you do with a traditional mortgage, the interest accrues over time and is added to the balance of the loan. And the loan is typically repaid when the home is sold and when the last home owner moves out permanently or upon death. You still own your own home. Your name remains on title. You're still responsible for property taxes, property insurance, and maintaining your home. The key difference here is that there are no required monthly payments, and that's what's advertised a lot. Now, in Ontario, you can typically borrow up to 55% of a home's appraised value. The exact percentage, though, depends on your age, your home's value, property type, and location, and the lender's criteria. The older you are, the more you can usually access. So, for example, if your home's worth $800,000 and you qualify for a maximum of 55%, you could potentially access about $440,000. You can take this in either a lump sum or monthly payments, your choice. And that doesn't mean that you should borrow that much. It simply means that is often the upper ceiling. So someone in their late 50s may qualify closer to 35 to 45%. Someone in their late 70s and 80s may qualify closer to the higher end. So this is not a flat number. It adjusts primarily based on your age. So how does it differ from a traditional mortgage or a HELOC? Well, with a traditional mortgage, a home equity line of credit, HELOC, qualification is based on income. The lender needs to see that you can make the monthly payments and know that when the economy is tight, qualifications tighten among lenders, so which can be really hard to qualify when you're a retiree. With a reverse mortgage, qualification is based primarily on your age and your home equity, not income. That's where the advantage comes in. There are no required monthly payments, as I've already mentioned. The funds received are tax-free because they're loan proceeds, not income. And typically, they don't impact your old age security or other income-tested benefits, which is also a great benefit of this. However, interest rates are higher than traditional mortgages and typically about 2% higher. Today, a fixed rate mortgage is somewhere in the 4.25 to a 5 range, depending on what you qualify for. A reverse mortgage then is in the 6 to 7% range and might be slightly higher. So you're paying a premium for this type of loan. Why? Because the lender is waiting to be repaid sometime in that future. They're not receiving a monthly principal and interest payment like they would with a conventional mortgage. That delayed payment creates risk for the lender, and the interest rate reflects that premium. So it's not free money, it's a deferred repayment. That's important to really understand. And compounding is real. Then what are the advantages? Well, a reverse mortgage allows retirees to access home equity without selling their home, and that's a big advantage. It protects monthly retirement cash flow. It does not typically interfere with the government benefits like old age security. And in Canada, there is no negative equity guarantee, meaning you or your estate will not owe more than the fair market value of the home when it is sold, provided your loan conditions are met. So for the right person, this can really create flexibility. But we need to understand the cost. How does this work? Well, reverse mortgage interest really looks like what does it really look like? So I'm going to give you a real example here. Assume your home value is $800,000. You borrow the $440,000, which is 55%. Interest rate is 6.25%. No payments are made. Interest is compounded annually. After 10 years, that $440,000, what is owed is $808,000 is owed. So that means about $368,000 in interest has accrued over that 10-year period. Now, the loan balance has nearly doubled. And after 20 years, that $440,000 over 20 years is $1.485 million. That means roughly $1,045,000 in interest has accrued over 20 years. That is the power of compounding. Now remember, because of Canada's no negative equity guarantee, you will not owe more than the home's value when it's sold, provided, again, the loan terms are all met. So this math really matters because this is why reverse mortgages are not a casual decisions. They remain in place. The longer they remain in place, the more powerful and compounding becomes. And this is exactly why using it strategically for a short time frame, such as preparing your home for sale, is a really very different from holding it for, let's say, decades. What's the risk and downside? Well, reverse mortgages are more expensive than traditional mortgages. They're about 2% higher. Interest compounds. I've just demonstrated that for you. And equity decreases over time. If family members are expecting a large inheritance, that expectation, and it hasn't been discussed, this can create conflict later. Using funds without strategy can really erode your equity quickly. It should never be the first option explored. It should be evaluated alongside downsizing, refinancing, and financial planning alternatives. So here's the hidden strategic use when preparing to sell. This is the conversation that really rarely happens. And if you're retired and living on a stable pension or investment income, your cash flow works, but your home needs updates before selling. Maybe flooring is worn, maybe it needs fresh paint, or lighting is dated, maybe the hardware needs updating, or repairs have been deferred like furnace and roof repairs. You know, these updates would increase your buyer appeal, but you don't want to dip into your retirement savings. Instead, you use a portion of your equity to fund strategic updates. You protect your retirement income. You evaluate the presentation of your house. You elevate the presentation of your house. This, I can't stress enough how much value and reduced time on the market this really means for you. You increase competitiveness, and when the home sells, the reverse mortgage is repaid from the proceeds. So used thoughtfully, this can mean a faster sale for you, stronger offers, higher sale price, definitely with those upgrades, less financial disruption for you. So this is not about like luxury renovations, redoing the whole kitchen. It's about targeted improvements that increase perceived value. Small upgrades often drive meaningful price differences. And that's a very different use case than holding a reverse mortgage for like 10 or 20 years. So who then is this strategy for? Well, this may make sense for someone who has had substantial equity in their home, has a stable retirement income, plans to sell within a defined time frame, and wants to maximize that return when selling. It does not want to liquidate. You don't want to liquidate all your assets. It may work well for someone who are in, let's say, their late 70s or 80s and who want to remain in their home instead of moving out. Again, you need to be thinking of how long you plan on staying in your home. This is really critical part of the planning process when using a reverse mortgage. It likely doesn't make sense for someone with minimal equity or uncertain plans. This is about a thoughtful leverage, not reactive borrowing. A reverse mortgage is not a miracle solution. It's not automatically a mistake either. It's a tool that can be used for you. Used carelessly, it can create problems, and used strategically, it can create flexibility, control, and in some cases, really a strong financial outcome. So especially when preparing a home for sale without disrupting retirement income, the key is understanding the numbers. The other key is alignment with your broader retirement plan and making decisions from clarity, not fear. If you're retired or preparing for retirement and wondering whether this could fit into your downsizing strategy, have a conversation with a mortgage professional. They can help you go through all the numbers, understand the math, explore your options, and choose what aligns with your next chapter.